Happy New Year, everyone. I hope you had a wonderful holiday season. It's great to be back in the saddle and looking forward to a prosperous and healthy 2024. This is going to be a bit longer than usual. It's a year-end version, so we're going to look back at the year that was in 2023 from a high level. We're going to lean into history and then evaluate the investment landscape in 2024. So this is going to be a historical context, kind of a State of the Union piece as opposed to a prediction piece, which for those of you that follow Pure Portfolios, we do not make predictions. So I hope you enjoy this. And I titled this piece, Not Too Shabby, How Many People Saw That Coming? No one saw last year coming. It was an unbalanced year, and then we had a pretty nice rally as we headed into the end of the year with the Fed pausing and then telegraphing a cut. And of course, inflation coming down allowed the Fed to pivot. So the market liked that, and higher rates didn't crash the economy. Inflation looks like it's behind us, knock on wood, but certainly there's no shortage of things that can go wrong. Let's get into the slides. I'm filming this on Wednesday, January 3rd. Okay, I find these graphs amusing because there's no shortage of things that can go wrong in any period of investing. So the markets climbed the wall of worry. Most people were pessimistic heading into 2023. And look, it got off to a choppy start. You can see here. So this is the S&P 500 for the calendar year of 2023, along with some headlines that dominated the news flow throughout the year. And it's funny, I think there's only so much space on this screen, but other things popped up too that are not on here, like the demise of the dollar, government shutdowns. There was no shortage of narratives. I call 2023 the year of the narrative because everybody had a fancy sounding narrative about how things were going to get worse. The market shrugged off all of that, and in the face of all that, ended up posting a pretty nice year. So you can see some of the headlines that dominated. I highlighted a few. No one saw several banks failing in the first quarter of 2023. That's consistent with what I've said in the past, that what derails markets, and this certainly did cause some stress in the spring of 2023, is seldom what people are talking about. Risk is what's left after you thought of everything. And if you're reading about it in the Wall Street Journal or your friends talking about it, the market has probably priced that in. What ends up derailing us is what you cannot see coming. That's true risk. So think COVID, think the financial crisis in 2008. No one was able to conceptualize how deep and painful that was going to be. And then there was all these geopolitical things too. So multiple wars breaking out. You had a Speaker of the House that was removed. The market shrugged off all of that and again posted a pretty nice year. So the takeaway is there's always going to be stuff to worry about. There's never a period where it's a flashing green light, nothing to see here. You have a path to enjoy 10% gains without the worry of uncertainty or volatility or risk. This is the cost of admission. All of this is very much normal. And that's why you're compensated in the form of this, an upward sloping line, because you're being paid to assume a lot of this uncertainty and risk. So don't think of any of this as the market's broken or there's a quirk or the world's ending. Go back to any period. There's a laundry list of things that could go wrong. Okay, so contrary to the narrative out there, this is a new bull market. A bull market is defined as 20% to the upside. Okay, so what this goes back to 1928, and it tries to capture the average or median length of a bull market. So this is where we're currently at now. This recent cycle started in the fall of 2022. October 2022 was the low. Since then, we've had a pretty nice rally. Of course, it hasn't been a straight line. It's been choppy, but it's exceeded the 20% threshold. We're probably on day 440-ish, which you can see the median post-World War II bull market in length is 1,324 days. Okay? So historically speaking, we are in the early stages of this bull market. If we get the median bull market, that would take us into roughly 2026. Again, this isn't a promise of what happens next. This is just looking through a historical lens. So we just looked at average length median length of a bull market since 1928. This is since 1928, the average or median gain for a bull market post-World War II is 86%. Right now, you can see, again, from the bottom of October 22 to the end of last month's close, we were just shy of 30%. So again, if the average or I keep saying average, median length, median gain, that would put us at around S&P 6,700 in the spring of 2026. But again, you can see some of these bull markets are quite shallow, some are quite long. This is just the median. So the truth probably lies somewhere in between, but this is just to, again, to provide context. And this is a nice bow on all of that. So this goes back to 1956 for the S&P 500, a summary of all the bull and bear markets. And I think this does a really good job of capturing the bear markets, which again is marked by about 20% on the downside. And you can see there's been several of those since 19. You can see the length here, 15 months, 6 months, 8 months. So in parentheses, that's the length. And then on the bull market side, which again is up 20%, you can see the gain, the cumulative gain, and then the length of the bull market, 74 months, 60 months, 31 months, just to provide a sense of bull and bear as it relates to history. And of course, this light gray line is the S&P 500. So a few things stick out. In general, bull markets last a lot longer than bear markets. I think that's obvious when you just glance at this graph, that bear markets tend to be much briefer and bull markets tend to be much more lengthy. In that same vein, bear markets tend to be much more shallow. Of course, there are exceptions. There's some nasty dips here, minus 47%, minus 55%. That's a potential outcome when you're an equity investor. And on the opposite side, bull markets tend to be much more aggressive on the upside. So bear markets shorter in length, much more less intense on the downside. Bull markets longer in length, much more intense on the upside. So a caveat here too. So some people are like, well, Nick, why wouldn't I just invest all of my money in the S&P 500? Okay, that's a popular and reasonable question. My answer to that would be, okay, Mr. Retiree, can you stomach losing over half of your assets when you have zero capacity to re-earn that money? You basically have to wait for the market to bounce back. And most people would say no if they're being honest. Some might say, oh, no, that's fine. But people tend to overweight what just happened. What just happened is it's been a pretty good run over the last 12 to 13 years for U.S. large cap stocks. Most people wouldn't have the emotional or financial capacity to take a 50% drawdown or a 50% loss on their investment assets. So that's why we're not shoveling money into the S&P 500. And folks soon forget that from 2000 to 2010, the S&P 500 was flat. No one was asking me, hey, Nick, should we invest 100% of my assets in the S&P? Because it hadn't done very well. It was a lost decade. So if you parked money in the S&P in the year 2000, look back over the 10 years in 2010, you would have made some dividend income, but your principal would have been essentially flat. So again, people overweight what just happened, and it's been a historically good run, I should say, for U.S. large cap stocks. Now, there's been a lot of talk about the top heaviness of the S&P 500, meaning a handful of stocks have explained a good chunk of the S&P's performance in 2023. And that is mostly true. It was a very top-heavy year, meaning the Apples, the Microsofts, the Googles, the Amazons, the big tech stocks drove a good chunk of outperformance for 2023. And in some cases, once you stripped out, at a few points last year, once you stripped out those big tech companies that I just mentioned, the S&P was actually down. But a funny thing happened at the end of the year in the fourth quarter. Those out-of-favor equities, the small caps, the mid caps, started to catch up. The rest of the S&P that was out of favor, they really started to catch up. So I'm going to glance at my screen to make sure I don't get this wrong. But if you strip out the Magnificent Seven, the 7 biggest tech stocks in 2023, the S&P still returned 10.5%. Okay? If you looked at most points during 2023 and stripped out the 7 biggest or best stocks from a performance standpoint, that number would have been negative or flat a good chunk of the year. So that fourth quarter, the have-nots really made up some ground on the Magnificent Seven. Now, I don't know what that means going forward. I would temper my expectations. Okay, so instead of the 30, 40%, you might be able to capture a lower rate of return, a market rate of return. I think the days of just investing in a handful of tech stocks and printing money might be gone, but I also could be wrong. But if you look at the range of outcomes for these companies over the last 24 months, it's been absolutely absurd. A lot of these darlings of last year were down 30, 40, 50, 60% in the case of Tesla, and they've snapped back just as aggressively. So, most of our clients are retired. Again, I'm not saying that we can't own these. We do own these stocks in a handful of our strategies, but I would be very aware of position sizing and managing expectations going forward. All right, this is one of my favorite graphs, and there's a lot going on here. Looks complex. It's actually very simple. So this is sentiment. This is basically how investors are feeling about the stock market, okay? When this number is negative, and you can see the readings over here. When the number is negative, that means people are feeling bad, okay? When the number is positive, that means people are feeling good. There's more optimists than pessimists. Depending on these readings, either feeling bad or feeling good, we're able to track future equity performance for the S&P 500. So future performance for the S&P 500 over 3-month, 6-month, and 1-year periods based on how people are feeling. And in general, when people feel like garbage, which they did in 2022, the end of 2022 at the start of 2023, we were hanging out in this neighborhood here. Future returns are really quite good. When people are really, really optimistic and they think they can't lose money and equities only go up, future returns are poor, negative, in fact. This is the current reading now. The current reading is 30 plus 32. So between 30 and 35, there's been 63 instances of that reading going back roughly, I think, 70 years. And this is what future returns are for 3-month, 6-month, and 1 year for the S&P 500. So looking at the 1-year number, up 6% based on this reading, that's certainly not bad, but it's below the historical average for all periods, okay? Looking at where we were at last year, we were hanging out negative 40, negative 35, somewhere in here at periods. 1-year forward returns were actually quite good, plus 22%, and that's basically what we got in 2023. So in general, sometimes we forget, with all the technology we have today, all the algorithms and black box trading and AI, markets are still humans trading with other humans. And although the economic cycle, the reasons the market goes up and down are different as you go through the decades and go through the years, the human reaction is very consistent. Meaning when people feel bad, future returns are good. When people are pounding the table saying to buy equities, this is a great time to invest, future returns are usually not so good. So we pay very close attention to market sentiment, to investor sentiment, to what people are saying. I think it's behavioral finance is the most understated and misunderstood component to sound investing. So we talk a lot about our rules. This is part of our rules here. When people are feeling bad, we might become a little more aggressive because future returns, as we've seen, can be better. When people are euphoric, that might be time to exercise caution and pump the brakes. Okay, so in my November commentary, I got a lot of positive feedback about the Three-Headed Monster, which the Three-Headed Monster is the price of oil, the 10-year Treasury yield, and the U.S. dollar relative to a basket of currencies. In general, when those three things are going up, higher oil prices, higher bond yields, stronger dollar, that's historically bad or a headwind for the S&P 500. Okay, and you can see that here. So the red line is the three-headed monster inverted. So essentially when this line is going down, that's oil going higher, bond yields going higher, the U.S. dollar going higher, and it's inverted, so it's kind of counterintuitive. But when this line's going down, that's essentially financial conditions getting tighter. The market in blue, the S&P, does not like that. So you can see this is very closely, the S&P is very closely correlated to the inverted composite index of oil, the 10-year Treasury, and the U.S. dollar. On the flip side, so this is essentially the bottom back in October of 22, when financial conditions get easier, meaning the price of oil goes down, the 10-year Treasury yield goes down, the U.S. dollar weakens. That's the red line going up. That's the S&P going up. Sure, they can become disjointed at times. This was a bit of a messy year with the inflection point of the Fed. Are they going to raise rates? Are they going to pause rates? Are they going to cut rates? But in general, these two lines, the inverted version of the three-headed monster, are closely correlated. So we watch the price of oil, the 10-year Treasury yield, and the U.S. dollar relative to other currencies because it is very closely correlated to what the market does. So as this line has gone up, that's conditions getting easier. Market likes that. Market has had a pretty good rally at the end of 2020. So this is the three-headed monster the last 2 years. Not to get political, but this is an election year. This is starting to become a topic of conversation. I wrote a blog about this. 2024 hot election talk and market returns. I would encourage everyone to read that because contrary to what you'll read on the news or what your friends are saying, whoever's sitting in the White House, whoever gets elected, whoever does not get elected, matters much, much, much less than you all think. Okay? So this is the average S&P returns over a 4-year presidential cycle. Okay? That's this blue line here, the dark blue, I should say. Usually the first year of the term, I should say, is positive. The second year is a little choppy. Third year is really good. Fourth year is pretty good too. When you look at President Biden's S&P chart, it's basically following this path but on steroids. So the first year was really, really good. Second year was really, really bad. Third year was really, really good. Fourth year is to be determined. So what I'm saying is President Biden's chart, as it relates to history, is following the path just on steroids. Okay, that doesn't mean this year is going to be really, really good or really, really bad. But on average, the fourth year of a presidential cycle is decently good. And as I've always said, politics and investing do not mix. Politics versus sound investment principles. The market doesn't really care who's sitting in office. Markets have historically rewarded long-term investors regardless of presidential party. I think a picture is worth 1,000 words. Sure, there's blips, but in general, presidents get too much blame when things go bad. They get too much praise when things go right. And the fact of the matter is private business, corporations, consumer behavior, the Federal Reserve, interest rates, inflation matter much, much more than who's pulling the strings in Washington. One person doesn't have that much control over a complex global economy that's more interconnected than ever. So, again, just don't mix your politics with investing. I know this stuff is going to heat up as we get closer to the election, but this is the growth of $1 for the S&P over the last, 60 plus years, and you can see this line is upward sloping to the right, regardless of what party or what person is in office. All right, lots of whispers about a recession, hard, soft landing. What this is we're basically tracking S&P performance at various levels of GDP growth, and we go back to 1948. So in the third quarter of last year, we got an annualized GDP reading of over 5%. I believe it was 5.2%. And that reading registered in the 70th to 80th percentile, meaning it was a pretty high reading relative to history. It was a pretty good GDP print, okay? From those GDP growth levels, future S&P performance for next quarter and the next year are actually quite good. So on average, once we hit that 5% GDP annualized growth figure, which registers pretty high when you look at history, the next quarter is up 5.5% and positive about 84% of the time. Over the next 12 months, up about 11%, positive about 81% of the time. So I know there's a lot of hot recessionary talk. The GD print that we recently got in the third quarter of 2023, there was nothing recessionary about that. Okay, I'm not saying we can't get a recession. I'm not saying that the consumer's not stretched and debt levels are too high. Certainly there's things that could go wrong. But what actually happened, the GD print that we actually posted is not consistent with a recession. And future equity returns based on that level of growth in the U.S. since 1948 are actually quite good. Interest rates. Okay, so we've gotten some clarity from the Fed. It looks like they are going to pause, which they have. The market and the Fed now are sniffing out rate cuts. Okay, so I think this is a simple but also a very important graph because, as I've stated in the past, weird stuff can happen when the market expects one thing and the Fed is saying or expecting another. When those two don't jive, you can get some pretty hairy episodes in equity markets. So this is where we're currently at, and this was published as of last Friday, so this is fairly recent. So every Fed meeting, the Fed chairman, they do this little dance with their Fed governors and all that, and they basically publish a dot plot, meaning where they expect rates to be in the future. And this is where the Fed expects the Fed funds rate to be at the end of 2024. What is that? 4.5%. Okay, and we're currently at 5 to 5.25%, I believe, maybe 5.25 to 5.5. Okay, so the Fed expects interest rates to be still higher but moderately lower from current levels. The green line is what the market expects. So there's some very smart investors that are betting with their own capital where they think interest rates are going to be at the end of 2024. And the market, which tends to be right more often than not, thinks interest rates are going to be around 3.75%, so almost 1% lower than what the Fed thinks. This is not an issue today because we have 12 months and the Fed is very data dependent, and these probabilities do ebb and flow. But if this was to be a consistent gap throughout the year, meaning the Fed is speaking a different language than what the markets are speaking, that would be a risk-off episode in our opinion. So it's best when these two are jiving and consistent. I think they synergized, meaning they came together at the end of last year, at the end of the third quarter. We saw that nice rally. That was basically the Fed and markets basically aligning with their interest rate projections. This is something that we're going to watch closely, this gap here. But long story short, rates look like they're going to be higher for longer. The Fed is going to be very careful and slow in their eyes if they do decide to cut rates because they do not want inflation to rear its ugly head again. Inflation tends to be very sticky on the upside. All right. If investor sentiment was my favorite graph, this might be tied for first or in second place. So what this is a distribution or a frequency of S&P total returns going back to 1957 all the way through 2023. It basically stacks up how frequent various return levels are. So on the extreme left, these are negative or ugly events. So this would be a loss of 30% to 45%. You can see 2008 fit in this ugly bucket. Next would be 15%, negative 15% to negative 30%. There were 3 instances of this pretty ugly bucket too. You can see 2022 was in there. And then from 0 to negative 15%, there's been 11 instances. And you can see all the various years. On the positive side, 0 to 15, you can see all the years that fall in that bucket, 19 instances. 15 to 30%, 23 instances, including 2023. And then really, really good years, 30 to 45%, 10 instances. So at the turn of the calendar, we're getting heavy into prediction season. I published my 'Tis the Season for Wall Street Forecasting. I think being prepared, engaging with history, understanding surprises happen, not being so surprised by surprises. I think that's a better approach than getting out a crystal ball and trying to predict what happens next. If we're being honest, Wall Street has been dismal the last 3 years. Pretty much everybody has been dismal the last 3 years, in any other year really you can look at. But the last 3 years especially, there's been a lot of surprises, and I go back and read what Wall Street was saying about the following year, and nobody had COVID on their radar. No one had a Ukraine-Russian war breaking out. No one had an Israeli war breaking out. No one had a banking crisis in the first quarter of 2023 breaking out. So, I hate to beat a dead horse, but people like to pursue certainty. They like the illusion of certainty. And I think it's better to understand history. And look, like when you break this down, something like 75% of the time, the market goes up. That means 20 to 25% of the time, the market goes down, and occasionally the market gets really weird. And a few things are sticking out to me as I look at this. the extreme negative event that so many people are worried about, it does happen, but it doesn't happen all that often, right? I mean, you might call it an outlier, but it doesn't happen all that often. The second thing is there's a pretty heavy positive skew to the right here, meaning markets want to go up. Again, that sounds aloof to risk. It sounds simple, but markets do want to go up. And when you stack this up, again, about 75% of the time, the market does go up. And about 30 to 40% of the time, the market goes up by a pretty healthy chunk, 15 to 45%. So when you stack this up, it's about 40% of the time the market really goes up. And less frequently, it's up low teens to single digits. So I think the end of the year is a really good time to check back in, to recenter yourself, to engage with history. Try to refrain from predicting, and I think you'll be less surprised by what goes on when you understand context, you understand history, you understand range of outcomes. So thanks for tuning in. This is about 30 minutes, a good time to pause. If you have any feedback or questions, let us know. If there's a topic you want us to touch on, feel free to shoot us a note at insight@pureportfolios.com. Again, I wish you all a wonderful new year, and we'll see you next time.